Now. Hello and welcome to an exclusive panel here. Today we're going to be talking about distressed real estate, navigating foreclosures, workouts, and COVID wreckage with two industry titans, leaders, rock stars, whatever you want to call them. These guys know what they're talking about. Lots of experience under their belt, collectively well over 60 years of experience in commercial real estate. And that's Michael Flight and Adam Gower. We'll start off with the bios here real quick, guys. Michael Flight is a real estate entrepreneur who is an expert in retail real estate, investment, leasing, operations, and redevelopment. Michael has been active in commercial real estate for over the past 34 years and has handled more than 600 million worth of real estate transactions. Michael is the president of Concordia Realty. Concordia was founded at the height of the savings and loan crisis in 1990. Michael has worked on distressed real estate in 4 cycles, performing workouts of foreclosed assets and properties in bankruptcy. He has completed successful assignments for banks, insurance companies, hedge funds, and REITs. He is currently finishing a book on the benefits of single-tenant net lease real estate investments. Part 1. Now, part 2, our other slugger, Dr. Adam Gower, who is an authority in content marketing and online communications for the real estate industry. He has more than 30 years and 1.5 billion worth of transactional experience in commercial real estate, finance, and investment. Over the last 5 years, he has built a digital marketing agency at gowercrowd.com and advises clients on how to raise capital during good times and bad. To learn how to raise capital from the high net worth investors online, watch Dr. Gower's whiteboard workshop. And you can find that at gowercrowd.com. Anyways, Michael and Adam, happy to have you here. I don't often interview someone with the same name as me, but I know we've joked about this before, and I've had you on my podcast too, Adam. So right. Good to have you guys here. I've got a little bit more introduction on my end, but I do just want to flip it to you here real quick to give a hello to everyone. So we'll start with Michael and then Adam.
How you doing, guys? Pleasure to be here. Adam, thank you for putting this together. And thank you, Adam Gower, for jumping online. We've had a number of really fruitful discussions and been able to, trade some different ideas and stuff. So looking forward to talking about this as well. I always learn something from Adam.
Thanks, Mike. You're very kind. And actually, there's some very bright people. I mean, there's very courteous introductions, Adam. But there's some very bright people with a lot of experience on this call. So as we roll into it, I would love to hear what other people participating are actually seeing in the market when it comes to distressed real estate or any kind of opportunities that are emerging out of the current situation. Seriously, most of the people I've been speaking to are still scratching their heads, wondering where those opportunities are. So if anyone is seeing them, I'd love to hear about it.
And I want to say what kind of created this coming together today as well was a conversation I was having with Michael not too long ago. And I think we were just looking at a couple deals that were in the marketplace. And for me, this is, I'd say really definitely my first ever real estate market downturn that I've ever been through. And so I'm not even thinking twice of maybe some numbers and projections.
Fairly certain you could call it a crash, but
crash. This is my first crash. You've been through 4, so I guess you have the right to call it a crash. But yeah, so I mean, it's my first time, so I don't really know what's normal, what's expected, etc. And I think it was just interesting to me to hear Michael's insight on not why someone was wrong, but how somebody could be wrong and they don't even realize it because they've never been through something like this before. And so I was like, wow, that'd be really helpful to have someone like Michael and Adam who have seen this time and time again come together with us here today and share this information. So that's the direction we're heading with the conversation. A little bit of a panel discussion. We're going to open it up at the end, say around the final 10 to 15 minutes for Q&A if we have any. Questions, guys, be sure to use the chat box and go ahead and use it right now as well. If you have any questions along the way, we want this to be super interactive. But we do have a lot of great things to dig into here as well today. And so we're going to kind of start off simple here because this is a term that I didn't really even know myself until Michael schooled me on it. But Michael, could you first open up to everyone right now? What is a workout?
Well, workout is a term, and for lack of a better thing, it's when lenders have a problem loan, they'll have to put it into a workout group. So they'll either, let's define another term. If it's a CMBS lender, which is a commercial mortgage-backed securities lender, those are publicly traded bonds. And so if that gets put into a workout, it goes from the regular servicer, which is a master servicer, to a special servicer. And then once it gets to a special servicer, then they start working out the loan and try and resolve the issue and see if somebody has enough. And it's the same thing with a bank. A bank, will, if you start talking to a bank, a lot of times the loan officer that you worked with has some leeway. But once you decide, or something happens where they decide there's not enough equity, they're going to throw it into a workout group. And so the workout group is then, people that are most of the time trained or sometimes learn on the fly how to deal with a distressed asset.
Yeah, I was going to chip in there and say that a workout is something that my wife wishes I would do with considerably more frequency. But in a banking sense, the simplest definition, and I'll tell you something, one of the hardest things talking to a group of folk like this on the call right now is knowing how much you know and don't know, because it's really easy. And one doesn't want to talk down, but at the same time, you don't want to, miss some obvious stuff. But the single most important thing about a workout is that you have essentially a borrower who is unable to pay on their loan, right? And any kind of discussion that you have with that borrower as a lender is essentially a workout, right? Wherever it's coming from, you're trying to figure out a way of working out the problem and coming to some kind of financial, resolution to their inability to pay.
And that's why,
in really simple terms.
That's why Dr. Gower is an educator. You can boil it down to a simple concept.
Well, during the last downturn, that's all I did. I was parachuted into a major bank. And I know you have a lot of experience with banks as well, Michael, but I was parachuted into a major bank. And you know what? I really didn't know. One of the first terms going into the last downturn that I had no clue what it was a note. I remember getting an email at the beginning, really, really early on, probably in 2007, from somebody saying they had a tape. It's like, what? Got a tape? And they were talking about notes and et cetera. And I have no idea what they were talking about until I actually parachuted into a bank. It was like landing in a war zone of workouts and dealing with loans that were not performing, right? Borrowers weren't paying on the loans. And so really the best way to understand these concepts is to actually have to go through it, Adam. Unfortunately, everybody has to go through it at some point. It would be nice to think that there is never going to be a downturn, that there is never a downturn, but we all know that's not possible, right? Obviously.
And yeah. Adam, a workout is you're trying to preserve as much of the bank's capital as possible, because most of the time when it does get into a workout, it very rarely stays with the borrower. Sometimes it does, but if the bank feels that they can get their capital back, but their capital being the loan. So they just want to get as much of the money that they lent out to the borrower back. And so that's doing different things and trying to preserve the capital of, their investors and, the government, because a lot of times of the bank, the government, there's 4 or 5 different bureaus in the government that are watchdogs over banks. So.
All right. And now getting in a little bit more to some really, I'd say, compelling questions and topics that we've got laid out here today. Everyone's starting to wonder, what food groups in the real estate industry, and what markets are going to be the places to go and find these distressed properties and opportunities that will ultimately make us come out on top when this downturn, this crash is over. So, Michael, I'm going to start with you. As I mentioned, that's the first question here. What markets and food groups do you anticipate the most distressed real estate to come from?
Well, right now, I see that, and Sam Halawi probably has the most experience with this, is malls and hotels. So those are the most immediate issues. I think that there's certain parts of retail that have done very well, especially grocery anchored shopping centers, but other parts of retail could be affected long term. And then the other thing is it's not going to show up right away, but if large corporations decide that they don't need as much office space, or that people aren't comfortable coming back into the offices, you could see some issues a year or two out, because the leases are typically longer with central business district office buildings. And then at some point too, I'm concerned about central business district or downtown apartment buildings, because a lot of people might decide that they don't want to be in a downtown and they don't want to be locked down. So I'll throw it over to Adam.
Yeah, gosh. So the first thing that the first emails that I got during this downturn were aggressively seeking distress in single family homes. I actually found it quite distasteful, to be honest with you. I had this, there was a standing ovation for all the people who were going to be foreclosed on. And I just thought, you've got to have some discretion, really. I mean, don't be rubbing your hands with too much glee. But there's a lot of difference between this downturn and the last one, right? The last one was a banking crisis, right? Liquidity just dried up. The oil that was lubricating the entire economy just evaporated, if oil can evaporate, right? And everything just ground to a halt. This time we went into this with a really strong economy. Everybody, there was a lot of cash looking for deals. In fact, interestingly, there was a lot of money that was on the sidelines that actually pulled out because prices were seen to be too inflated already, and they were waiting for a downturn, right? Anticipating a downturn. And kind of not hoping for one, but knowing one was going to come, preparing for it. Of course, nobody could predict a pandemic as being the cause of that. But as we go into this, look, it's hard to think that this is anything but an anomaly, a kind of what Phil Anderson talks about, mid-cycle downturn, just a kind of bump in the road. Although we're still all sitting here, certainly I am totally paranoid, right? It's about getting this horrible pox. The fact is that, if somebody said there's a vaccine and we are anticipating that at some point, right, either in the near or mid future, then all of this discussion about distressed real estate really goes away. And what a lot of property owners are really thinking about now is how to survive through to that point, right? Until the economy does come back. And the other big difference, Michael, from the last time is that there's this massive economic stimulus that understands these dynamics, that is propping up the market. I haven't heard a single multifamily sponsor anywhere yet discuss any kind of distress. I mean, there are some deals that are going through that are somewhat discounted, but there are other factors involved in a dispute, for example, family dispute that's just being exacerbated by the downturn. They want to get out quickly, and so you're seeing some distress there. So I think the dynamics are different than they were last time, and probably much shorter lived. Although the obvious ones, of course, like you talked about, hospitality and retail are the key ones. We can certainly talk about office. Hello, Shah. Nice to see you.
Thank you. Thank you. Go ahead,
I
Michael.
want to just follow up on what Adam had said too. One of the things that I didn't think was going to be an initial thing, but if they do keep, certain areas of the country closed down, and the other thing is, I think you will see some distress in single family homes, but since they did the thing where there was a moratorium on foreclosures for 90 days, we might want to take a look at where those foreclosures are somewhere in July or August when that burns off. And then the other thing is, there probably is going to be a lot of people that will lose their jobs because there's certain businesses that just aren't coming back, especially with some restaurants, especially with some retail spaces. I don't think that, a lot of hotels, some of them might not come back at all, and they might have to be repurposed. But those people that are most vulnerable are the people that are working in those jobs, and those jobs might be gone. So once this extended period of unemployment burns off, and once all the other things in the eviction moratoriums and the foreclosure moratoriums, we could see some distress in multifamily and single family. I'm hoping we don't. I'm hoping that this thing just explodes back, but that you should watch for that.
Here's something that's interesting, right? So there will certainly be some. It will be a lot less than the last downturn.
Right.
But do you think so how do you think it's going to play out? Because everyone around this table today would like to think that we're going to be able to find some, undervalued real estate that we can get our hands on. Not because someone's suffering, but because they over-levered, right? Weren't able to protect the assets that they have. But there's so much everyone around this table would like to buy, right? So unlike the last time when liquidity was sucked out completely. So unless you're in exactly the right place at exactly the right time and are able to jump on something super fast, it seems like opportunities will be considerably less than the last time. There was one thing that I was going to mention as well that you touched on, Michael, and that is this idea of functional obsolescence, which is also very different from last time. I used to like to say that there actually is no such, well, actually what I came to learn in the last downturn was that there really is no such thing as distressed real estate. It's a misnomer. Why? Because actually the real estate is okay, right? It's the finance, the capital stack that is distressed, and you have to recapitalize a project in somebody's going to take a loss. You have to recapitalize, and the real estate is okay, right? You've got apartments, everything's okay, unless there's some kind of toxic waste, and in that case, then it is distressed real estate. Again, the difference with this is that the very nature of the distress is causing some properties to become essentially obsolete, right? I mean, you talk about restaurants having 50% capacity, or hotels, or whatever it is that people just won't be going to again, or won't be able to function in the same financial way as they were before. That's really challenging, because how do you capitalize on that? Or how do you recapitalize that if the underlying business plan, if the underlying economics themselves have to be restructured, right? Not just the debt or the capital stack, but the whole business plan, if it has to be restructured. How do you deal with that with restaurants, for example? That's not rhetorical.
Michael, that's a great question. Are you ready for that?
Well, I have been looking at over the past 3 months, and we've done some restructuring of leases temporarily with restaurant tenants. The quick service, QSR, which is McDonald's and those guys, are probably going to be fine because they were primarily drive-through driven to begin with, but they're going to take a hit to their income because they're not getting at least 20 to 40% of their income that was walk-in income. The people that are going to be hurt the most were fast casual or sit-down restaurants. If they don't have some sort of solution, they just, the delivery thing just doesn't work for them because people are used to going. And so what you're going to see is you're going to see rents come down. I think you're going to also see rents come down with certain retailers because they're not going to be doing the same amount of volume, so they can't pay the same amount of rent. So that's going to really affect loan structures and cap rates and everything else. So I think you're going to start seeing certain, we were just talking about it today, that, Applebee's and Chili's and, some of those guys like Red Lobster, their rents might be depressed, permanently, and the cap rates, you'd want to get a higher cap rate for that. So, but we're going to have to see how it plays out. I'm not counting on a vaccine, but I, see signs that the thing is just going away. And, Adam Carswell keeps telling me that it's a scamdemic and not a pandemic.
So that's kind of interesting, this idea of restaurants, that rents will come down. So let's just kind of think through that, right? Because everyone's trying to figure it out. So if you're looking at a single tenant, you're writing a book about single tenant net leases, right? So you're really
Right.
the expert in this. So if you're looking, so the issue is that you've got somebody that owns the ground or owns the building and they have a single tenant net lease on a restaurant. And so they are looking at reduced rents in the interim, right? The short term,
Right.
short to medium term, but they still have to pay their mortgage, right? The bank is not going to be sympathetic to that. Very unlikely, right? So that's number one. So they could lose, those assets, and somebody buys them under the assumption that rents will be depleted or will be lower. And then there is a vaccine, right? Everybody starts going back and tables start to get full again. So that's potentially really where the opportunity comes. Is it? I mean, is that something that you anticipate, Michael, particularly with restaurants and triple net buildings?
I believe at some point people are just going to say, they're going to weigh the pros and cons, and at some point they're going to say, this is an acceptable risk. There's going to be some people that will never ever go out again. So, but we're seeing it in southern markets especially, and even there's a tremendous difference. I'm here in Chicago, and just to the north in Wisconsin, it's almost back to normal, and just to the east in Indiana and Iowa, things are, it's like, they're at reduced capacity, and the city of Chicago is still closed down. So there's no seated dining, versus if you just go, 90 minutes across the border to the north, and you can sit down, you can have a beer, and, people are carrying on as normal in most spots. So it's this weird dichotomy. But to answer your question, that's not on real estate. Tenants can only pay a certain amount of a percentage of their volume. And so if restaurants were paying, let's say 8 to 10% of their sales volume, and their sales volume was $1 million, and, a sit down restaurant, loses 50% of its sales volume, they're only going to be able to pay, less than, $50,000 instead of $100,000 that they were paying. So
And it's not a base plus percentage. There's no base.
Nobody's writing percentages anymore. And as Sam and the other guy that were involved with Liberty Fund, Jordan, said there is no more percentage rent, because how do you calculate percentage rent when tenants are doing things online? and when tenants are doing delivery, and how do you attribute that to specifically the store? You can do it a little bit better with a restaurant, but with a retailer, if it's buy online and pick up at store, and then, or the other thing is like Kohl's is doing returns for Amazon, or take in returns. So if they bought it online and then they return it at the store, does that get credited? So I believe it's just going to go to a fixed rent, and the percentage rent. The percentage rent has been going out anyway because lenders don't like percentage rent, because you can spend percentage rent, but you can't finance percentage rent.
So if you find a deal, presumably then now let's talk about about retail. You want to be signing presumably short-term leases, right? Because a short-term lease is going to be low to accommodate the depression in terms of revenues. But as soon as it does kick back up, which it will do, you want to be able to dramatically increase those rents, right? To reach
Do you think that's consistent across not just retail, but other food groups as well?
Just talking about retail, again, I'm just postulating, basically. I mean, everyone's trying to figure out where this is going. There are no definitive answers. It's very different. Hospitality, I've got a few notes on my desk here, desktop. Hospitality, gosh, that's how does that pull itself out? I spoke to Val Ross from STR, and she's predicting that hospitality won't come back until 2024. That's 4 years. That's extraordinary.
Yeah.
Right. I mean, that's just an incredible long period of time. When you think about repurposing or adaptive reuse of hospitality, that is, as nice as that might seem to be, that's not an easy thing to do, to convert a hotel into what exactly, right? Into apartments. What are you going to do? You got to put kitchens into every room, or build walls, or, I mean, it's not practical, really. So
I have heard an idea where somebody was saying that you could take, some of the hospitality and make it, because people still want to go to offices. You've just got basically the cubicles and stuff
that's an interesting idea.
Like a WeWork type of a thing, for individuals.
Right. Having said that, though, not many people are going to spend $400 a day. Right?
I agree with you. I agree with you. And that's the other thing. I think that, office buildings, I don't know if corporations are going to, commit to long-term leases anymore. If they don't know what, if they're like, well, do we really want to commit to a 10 or 15-year lease or a 20-year lease? Do we want to cut it back to a 5-year lease? Because, if this happens, we don't know if we're going to have to restructure our workforce again.
So office is a very interesting asset class. I hear all kinds of things all over the place. First of all, fewer people will go back to the office. Okay. But those that are in the office will require more space, right? So the square footage per person will increase. So if the number of people goes down, it's going to be zero sum at the end of the day. The other thing is that I enjoy thinking about, actually, having worked in a co-working space for a few years, is this idea that remote working is not synonymous with working from home. So if, let's say, it becomes the new normal that vastly more people do work remotely, right? So vaccine, everyone's healthy, but the economy has got used to, and companies have got used to having people working remotely. They stay working remotely, but, I actually, although I like working out of the house, I prefer working around other people. And so even if you're working remotely, to find somewhere nearby where you can be in the company of other people with a water cooler and a coffee pot, right? And all the chit chat that goes on, then to me, it seems like offices that WeWork failed not because the thesis was flawed, but because the economic structure was flawed. The way that they structured it financially didn't work, right? But people really liked and continue to like working in these super comfy environments surrounded by very bright people who are not working for the same company, from whom you can actually derive a lot of intel and a lot of benefit, right, from sharing ideas. In fact, there's no office politics in a co-working space because everyone's with a different company. So it seems to me that that the way people work out of offices might change, and that actually offices will maybe look different, but won't be hurt by this overall.
Yeah, really interesting take, because I know for a while, at least for me, since I've been in real estate, wondering how and when office could ever make a comeback. And now it seems like at least it has some life based on what you're saying. And Michael, I'm sure you had some follow-up for Adam there as well. I know we could we could turn this into a 3-hour podcast if we want, I think. But I just want to get one of these questions here. We got a question from Sam Halawi, and you guys already touched on this a little bit, but I think it'd be helpful to just go back to it one more time. Just like at first look, how do you identify distressed real estate? What are just some quick characteristics off the top of your head if you're just looking through a handful of deals? Start with, we've been starting with Michael, so we'll start with Adam on this one.
Not entirely sure I understand the question, but distressed deal is somebody who needs to sell quicker than they would normally like, basically. That's, I'm not really sure what does a distressed deal look like?
We do. Sam, you're still here on the line with us.
Yeah, unmute and if you can.
Appreciate you guys' time, Michael and Dr. Gower. So what I'm talking about is let's say, you're going through LoopNet and you're just looking at a ton of different deals. How do you identify it off the first look? Like, no one's just posting, this is distressed, get this off my hands. Sure, price reductions, it'll throw a couple, throw a flag, but I'm talking from, do you guys look for anything else? Just really from a high level perspective.
Super question. Go ahead, Michael. Yeah.
Okay. Sam, you're more than likely not going to find the quality stuff on LoopNet. So right. You would normally have relationships with lenders, or you would cultivate relationships with lenders. When Dr. Gower was talking about all the dry powder out there, there's guys that have raised a ton of money that are private equity funds that specialize in CMBS, and they came from the CMBS market. And so that's a lot of the guys that made a lot of money in distressed properties last time around in the CMBS market came from the CMBS market. Then other guys that made a lot of money, working with banks, typically were bankers or, came from the banking sector or had relationships doing, receivership or, again, in a workout situation. So that's, it's hard to, you can start cultivating those things right now and start saying things, but, it's also relationships built up, before this happens.
Yeah, you nailed it there, Michael. Sam, if you're looking online and seeing a nice glossy brochure and some nice photographs and a nice pitch deck, that is not going to be a distressed deal, period. What you're going to see when you see a distressed deal is chaos. There may be documents missing. You're not going to get the info that you want quickly. It's going to be a mess, and you got to dig your way through that mess. I actually just wrote an article on how to find distressed deals. And Michael, you've touched on this, but there are a few ways to find them. Looking for a listed deal ain't going to be it. One is to talk to brokers who might have clients who they sold buildings to, who they now know need to get out quickly, right? So you got to have basically relationships. Lenders, definitely talk to banks. If you can find friends at banks, special asset departments, loan officers that in commercial departments that have good relationships, they will also know. Again, you got to have relationships. Another good place is the courts, right? Just keep an eye on foreclosure notices of default. During the last downturn, what I did was actually drive around the streets of LA looking for buildings under construction because I knew that they were going to be in distress. Then researched with title companies who owned them, what else those people owned, and then who their lenders were. And all of that whole audience is going to be in distress, right? That whole little community. So you got to dig around and research. Appraisers. You could talk to appraisers, right? And see, they will know who their banks are calling appraisers out to appraise deals because they may have to mark them down on their books. So appraisers might be a good source to see if they'll tell you anything, right? Again, it's all relationships. If you don't mind, just one other thing is actually two others. One is specialist databases. There are a few. You might check out, this is a kind of a wacky one, but Property Radar. I just interviewed Sean O'Toole, who's the founder of that, propertyradar.com. They use heat maps in certain states, and you can track distressed deals there. Great place for research. And then the other place is planning offices. I mean, you can't sit at your computer and hope that a deal's going to pop up, you know, on LoopNet. You got to get out and go and talk to people downtown. Have they shown up? You know, planning offices, everything in a planning office downtown is public information. So you can ask for the file and they'll hand it over, and you can see who's delayed, who's not paid some fees, et cetera, and then start making phone calls.
Very valuable. Thank you.
And the Dr. Gower had mentioned banks. So the bank department, you would want to look for REO, which is real estate owned.
Or
And,
special asset group. When I went into the bank, we had a special asset department,
right.
SAD. So I immediately renamed it to Special Asset Group. I don't want to work for the SAT
It's pretty
department.
sad. And then the other thing is, if people are having problems, typically it won't go this far, but you know, if people missed a real estate tax payment, that's usually an automatic reason for the bank to foreclose on you, because the real estate tax payment is a lien that's prior to the loan. So the bank is going to then advance the money to make the real estate tax payment and then foreclose on you.
Yeah,
it's really valuable. Go ahead.
I was just going to say, it's all public information, so you can access it.
We got some really valuable information, I feel, coming out here this last 10 minutes. So I'm going to go ahead and push this back another 5 minutes, if that's okay with you guys. Fletcher Wheaton coming in with some great questions here too. Instead of me reading them, Fletcher, are you able to unmute and kind of just clarify what you're asking? Because it looks pretty good from what I can see.
Hey guys, appreciate the time, man. Learned a ton. I don't want to dominate it, so
Dominate it.
I'm curious about office space, and specifically in San Francisco. I've heard people very bearish on this, but I like what Dr. Adam had to say about it. Kind of made me think that maybe the work from home movement was a little bit too much overboard, and that in fact office space will be fine. And then the other thing is really low interest rates, man. It just seems like everybody is running and gunning and ready for it. I feel like, I don't know if it's warranted, that maybe like long term, what does that mean? Because it kind of feels like it's going to fuel this fire. Not necessarily like a 2007 or 2008 thing, but just curious on your take on those.
So fuel what fire?
I just feel like it's the low interest rates, right? You know, historically really low, will encourage more people to do more risky things that they wouldn't have done before. And it just feels like, especially within like, for me right now in like multifamily, it just feels like everybody's chasing the same thing. And then you throw free money into that, then you're just fueling up this fire. And then someone like me, I'm just looking 5-10 years down the road. What does that mean?
Okay, so I will jump in on that, because I actually spoke to a fellow called Phil Anderson on my podcast, and it came up just ever so briefly. It was kind of funny. I read his book. The Secret Life of Real Estate and Banking. Oh, you've got it, looky. That's it right there. That's the book. That's hilarious. No. So there's The Secret Life of Real Estate and Banking. He talks about an 18.6-year cycle. And he talks about, and you should definitely check him out. He's quite a fellow, actually. And what you mentioned, Fletcher, is exactly what he's talking about. That we are seeing right now a bump in the road and nothing else, right? As bad as it seems, it's a bump in the road. And that what's happening is that the governments all around the world are pumping massive liquidity into the economy. So when we pull out, we will pull out with this rocket fuel, right, in the economy that will drive prices to unsustainable levels. And what he talks about is this idea that when we do pull out, all the bankers, he points his finger at the bankers, and politicians will pat themselves on the back and agree at how fabulously well they navigated this crisis, only to see an astronomical price inflation come crashing down in 2000, and check out his book, 2020, whenever it is, he's got it like down to the day. So basically another few years yet before it actually, the real cycle comes to an end.
Unless the dollar collapses.
Or there's another pandemic. Just to, we shouldn't finish on notes like that. But yeah, exactly.
Here we go. We got a question coming in.
I mean, you can even
go ahead,
see
Michael.
The pricing in the stock market. Everybody's talking about how great the stock market is. It's like, well, when you've got the Fed pumping in all this money and then supporting everything in the stock market, and then even supporting money market funds and things. It's definitely going to work its way through, and it's going to end up in, more than likely multifamily, because you got the GSEs, but, Fannie and Freddie, backing that stuff. So you're absolutely correct. It is free money. But the U.S. government has to keep the interest rates low because they're, paying the vig on, close to $30 trillion right now.
So maybe, Fletcher, the opportunity is to just buy and turn quickly. And then around the end of 2024, mid-25, sell everything and buy golden guns.
If it's cheap debt, buy as much as possible, borrow as much as possible, and then invest the difference in gold.
There you go.
And don't forget to get your...
Might be a good webpage, goldenguns.com for 2025 there.
Is that the name of a band? I thought it was the name of
Guns N' Roses is what.
Oh, that's right.
Yeah.
If not, you can go .org.
Or you probably get more traffic with girls and guns, but
Girls and Goldie. All right, we should definitely stop there. This is
we've got to. This is great. There we go. And Mo's bringing in the Bitcoin now as well. It's another fun topic. We got a couple minutes here left, guys, and saw Sheldon came in here with a question too. Just Sheldon, want to give you an opportunity to also speak up and share your thoughts with Adam and Michael.
Yeah, I'm just kind of wondering what you guys think about the rent to own kind of scenario here, since people aren't going to be able to qualify for maybe the big mortgages anymore. Do you guys kind of see that as an avenue? Because we talk about distressed. So is it more that people are distressed, or is it, you're not going to find obviously the distressed property, but maybe the individuals that are trying to go get mortgages and trying to get back into being home ownership, like first time buyers? Would rent to own kind of be one of the markets right now to be getting into as like in lease options and stuff like that? Anybody who's might have some experience on it?
Look, Sheldon, there is depending on what state, I'm in California, so there is a very, very severe housing crisis here and a housing shortage. So probably one of the biggest surprises is that there has been no noticeable decline in house prices and certainly in demand for housing. So any kind of restructuring of how single family homes get financed is probably not going to be particularly dramatic. To the extent that there was a market for rent to own before, I can't imagine that changing very much, right? What you might see is a migration away, even higher demand for single family homes as apartment dwellers decide that they never want to live cooped up, right, with other people during another pandemic, and they would rather have four walls that they can protect themselves. So to the extent that there is any kind of increase in demand for single family homes, there's always going to be opportunities to provide financing options for people who might not otherwise be able to get finance. But whether or not it's a huge ballooning opportunity is open for discussion, right? It's probably going to stay the same, I would think.
Yeah.
Okay.
Sheldon, I don't have anything particular insight on this. I haven't done, we did housing and flips and stuff all the way up until 2013, and then I haven't touched it, so I don't know anything about the market right now. I think it could be a good investment thesis. I've been really harping a lot, and Adam says I harp on it too much, but the institutional investors have been pushing, no, the other Adam, the other Adam. The institutional investors have really been pushing ESG, which is environmental, social, and governmental. And I think what we found out in this particular situation that it might not be like immediate with a climate crisis, but you do have a huge governmental risk. And so you can see that I think there's going to be, and people are just leaving Chicago, New York, New Jersey in droves. They were already leaving and going to Florida. They were already leaving and go to Tennessee, and they're already leaving and go to Texas. And you're just going to see that much more, because if these states stay closed, I'm even seeing it in the Chicago area that people are just moving their businesses, and they had been across the state line to Indiana and across the state line to Wisconsin. They're just moving out even faster. And you can kind of see it with the unfortunate situation in Minneapolis, where the guy just watched his factory burn to the ground, and the fireman. So I'm gone, and so you're going to see people reacting, and they might not even think it through completely, but it's just like, I'm not going to stay here. I'm going someplace where I can do business, or I'm going and there are also, I believe there's going to be a migration there was all these huge apartment projects, and, and I don't want to say millennials, but younger people, which is natural. You go to the city, you have a good time, it's great. And then all of a sudden, but when this happens, I think there's going to be a lot of people rethinking, do I want to live, as Dr. Gower said, do I want to live, in this center city area, or can I just move out to a ring suburb, get plenty of land and stuff, and then if I want to, I can go in and visit the city. So I think that's probably going to be but those are going to take longer term. I don't think you're going to see those right away, but I would look for, especially in one more thing. California has this, rent thing where they're, preventing any evictions, and they're looking at extending that. They're also looking to do, eviction prevention or eviction moratoriums on commercial. They tried to pass a law that said you couldn't kick out, a commercial tenant. Do you really want to, work at a state or own, you're paying like a 5 cap or a 4 cap to have a building in California, and then the government just by fiat can say, well, you can't kick them out, and they don't have to pay rent.
Right.
So it's something that you should consider also, along with your normal due diligence. How friendly is the municipality, the government, and the state to operating a business?
Excellent points. Again, I keep looking down, and every time I look down, we've got something cool on the plate. So for the sake of this recording right now, we are going to say thank you everyone for joining us today. We're joined by Michael Flight of Concordia Realty and Adam Gower of GowerCrowd.com. And I almost messed up there on the closing because Michael You can also go, Michael and I would say part of our team at Concordia are also working on libertyfund.io. Go ahead and check that out as well. Guys, thank you for joining us here today. Everyone who's still here on the recording, I'm going to end it and we can close out just us guys. But for the sake of everyone listening, thank you for tuning in, and we will see you in the next special presentation like this one. Thanks.